Thanks for clicking. China made a number of headlines this week which could have major implications for global inflation, with St. Louis Fed President James Bullard warning that a reopened China makes him nervous about upward pressure on inflation. Indeed, as world leaders met in Davos for the World Economic Forum, the focus was largely on China's reopening and the effect that that could have on world crude prices. China also made further headlines this week on news that for the first time since 1961, it experienced a population decline, a decline which could have real implications on China's role as the world's factory.
Huge miscalculation.
Both higher demand for crude oil emanating from China, as well as China's declining birth rate, could have major implications on global prices, on the inflation rates for us here in the West, in the US, in Canada, and the EU, as the world prepares for China's reopening after over a year of rolling lockdowns and zero COVID policies. So what I want to do today is go over China's reopening and what that could mean for global inflation, take a look at China's declining birth rate and what that means for the rest of the world going forward, and then discuss what to look for next. China's reopening, for now, is the biggest story going for the world economy in 2023. We'll obviously continue to track that reopening on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into these crude prices. China's return to the global economy after over a year of lockdowns has many questioning the extent to which that is going to put upward pressure on global oil prices. Indeed, Executive Director of the International Energy Agency, Birol, said in Davos this week that China presents the clearest case of uncertainty going into 2023.
If you ask me, which is the biggest uncertainty, I would say it is China.
And that uncertainty over the Chinese economy has the IEA questioning the extent to which China's reopening will affect global oil prices.
Chinese economy is reopening, and we may see Chinese economy growing strongly. And if Chinese demand for oil is strong, it would put upward pressure on the prices. So China is, for me, the biggest, perhaps, uncertainty.
Indeed, according to OPEC, China's reintegration into the global economy could push up world oil demand by 500,000 barrels per day. Morgan Stanley issued a report this week saying that with China coming back online, crude prices could go as high as $110 a barrel, up from the current $80 a barrel that we have right now, an over 40% increase in the price of oil.
Everything is fine.
And this comes at a time when many in the West, in the United States, in Canada, are almost celebrating a reduction in our inflation rates, with the US inflation coming in at 6.5% last week. Yet it's important to remember that US inflation hit its peak of 9.1% back in June, at a time when crude was sitting around $120 per barrel. And while we measure inflation year over year, so even a return to $100+ per barrel by, say, June wouldn't have a major impact on our headline inflation rate, higher crude prices do affect the inflation rate in other ways, including service inflation, wage inflation, etc. And while a lot of work has been done in the West, in the United States, Canada, and the EU, vis-a-vis higher interest rates to get our inflation rates back down under control, definitely not there yet, but so far we're moving in the right direction. This work was done while demand in China was artificially suppressed. With China reopening and that demand set to shoot back up, it's not clear that the West won't see a major resurgence in our prices. Now, it is possible that a major economic slowdown in the West, in the United States, may help to tamper global oil demand as China's demand for oil rises and the US's demand reduces. Those two events, a recession in the West and an upsurge in oil demand in China, almost have to happen at very close to the same time for us not to see a major increase in the price of oil.
You're going to have to set goals.
Should the Federal Reserve fail to slow the economy in time for this resurgence of Chinese demand, then we could see a major increase in world oil prices, which, as we've seen, will obviously lead to a major increase in inflation. And it's not just news of short-term inflationary pressures coming out of China that had analysts concerned this week. We also received news that for the first time in nearly 5 decades, China reported a decline in its population growth, largely a result of China's one-child policy, which was instituted in the 1980s and abandoned 7 years ago. China is now facing major demographic problems, with 20% of its population over the age of 60, and some estimates saying that that number will reach 30% by 2035. And the worries reported this week was that as the working age population in China reduces, the number of adults available to work, as that reduces, that could raise the price of manufacturing in China. If there are 10 jobs available and 30 people to fill them, those 30 people don't have much bargaining power. That suppresses wages. However, if there's 10 jobs available and only 5 people to fill them, well, that puts upward pressure on wages as those 5 people have much more bargaining power. And the worry is that as Chinese labor becomes increasingly more expensive in the months, in the years ahead, that is going to push global inflation upwards. It's going to push the global cost of goods up. Indeed, as China has long held the position as the world's factory, as the cost of producing goods in China rises, so too does the global cost of goods. And while China's demographic problems is a slow-moving problem, it's not like it's going to happen tomorrow. China's reopening does present an immediate supply-demand problem. The global demand for oil has been artificially suppressed during the past year, and this was when Canada, the United States, and the EU all saw our inflation rates move to their highest level that we've seen in 40 years. And that's with a suppressed China. Artificially suppressed demand emanating from China. As things move back to normal, even with our higher interest rates, if the Western recessions don't hit at the same time, that Chinese demand for oil is going upwards and going to be going upwards fast, then we could see a real resurgence in the upward price of goods going forward, in the upward price of goods throughout 2023, which would obviously lead the central banks to engage in further rate hikes. With that said, we will continue to track China's progress in reopening its economy, in reintegrating with the world, and what effect that has on world prices and the world economy as a whole. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.